Hello, good morning. First, let me thank everybody who's joining us today for this International Tax Update webinar, which has been jointly organized by CMA and DLA Piper. Well, I really miss the presentations and seminars that we used to host in our office to our clients, but now we live in a different moment, in a different world. And at least through this webinar, we have the opportunity to keep presenting important discussions to you. For those who don't know me, I'm Humberto Marini, partner and co-head of tax at Campos Melo Advogados, which is a full-service law firm founded with more than 38 years with offices in Rio de Janeiro, São Paulo, and New York. Since March 2010, we have been working in cooperation with DLA Piper, one of the largest law firms in the world, which allow us not only to provide with services globally, but also to present discussions on the international legal perspective as the one we are presenting in this webinar. Today we are going to talk about the new mandatory reporting requirements for cross-border tax arrangements, DAC6, which are currently being implemented by all European Union member states that affect from multinational companies to individuals operating or with interest in the European Union. We'll also provide the key implications for transfer pricing as Brazil advances in discussions with the OECD. And we are very pleased to host this event. And I will now hand over to my partner and co-head of tax, Alex George, that will introduce our honored speakers and provide with some important information about this webinar. Alex?
Thank you, Humberto, and good morning, everyone. Thank you for joining this webinar. It's a pleasure to be here as well. And before I introduce our distinguished panel, who is going to be talking in a few minutes, I just want to provide a few housekeeping points. First, you may ask questions using the Q&A chat at the bottom of your screen. There is a function, the Q&A, and you can send us questions during the presentation. And we have allotted about 10 to 15 minutes at the end of the webinar to address those questions. In case we don't have time to address all the questions, we will answer them by email back to you. So make sure that we have your name when you place the question so we can come back to you. And this webinar is also being recorded and should be available in our social media by the end of this week. So without further ado, I'd like to introduce our panelists today. So the first one is Shibun Law. Shibun is the International Tax Director at DLA Piper. He's based in London. And in his role, he advises clients on outbound tax concerns by leveraging his international experience and also DLA's extensive network of lawyers, economists, and professionals. His work focuses primarily on international tax restructuring, tax policy, and controversies involving international and EU law. Shibun brings with him over 20 years of tax advisory experience, and prior to joining DLA, he worked in the OECD in France, IBDF in the Netherlands, and with the New Zealand tax authorities. I also would like to introduce you to Randall Fox, who is the head of DLA's International Transfer Pricing Practice. Randall is also based in London, and he assists clients in the global planning of intragroup transaction models, transfer pricing controversy across Europe and North America, and the face-related strategies with respect to transfer pricing worldwide for a number of large cap multinationals. Randall joined DLA Piper in London back in 2015 from the Internal Revenue Service in Washington, D.C., where he led teams on the development and negotiation of some of the largest transfer pricing cases in the IRS APMA program history. He's also a member of the Business at OECD, a frequent speaker on transfer pricing matters, a pro bono advisor to the World Bank Group on transfer pricing matters, and an appointed arbitrator of transfer pricing matters on behalf of the IRS. We also have Victor Campbell, who is an associate in the tax practice at Campos Melo Advogados. He has over 13 years of experience in international tax, advising both inbound and outbound transactions, including complex multi-jurisdictional M&A and reorganizations. Victor holds an LLM in taxation from the University of Florida and has worked in the United States for many years, where he gained experience in international taxation. So I would like to pass to Shibun, who is going to discuss about the EU mandatory reporting. And once again, I would like to thank our panelists for their time and opportunity to be here. Shibun, the floor is yours. Thank you.
Thank you, Alex. Thanks for giving me the floor to start off with some EU madness, I would say. I think before we start, just maybe a little bit of background around EU law. Tax is one of those legal aspects that is governed by domestic law in each EU member state. So in that sense, they have sovereignty. But the European Union often will try to influence the way the tax rules work in each country by issuing directives to get a level of consistency across these member states. And one of these instruments is by issuing a sort of a directive. And this directive essentially forces the member countries to actually implement specific rules to meet specific standards. So they serve as minimum standards. And the topic for today is really to cover one of these directives around EU mandatory disclosure rules under the Directive on Administrative Cooperations, or DAC. And this is because DAC6, because it's the 6th amendment to this Directive on Administrative Cooperation, and it deals with mandatory disclosure rules. For those of you who are familiar with the BEPS action plan, these mandatory disclosure rules essentially come from Action 12 of the BEPS action plan. It's a way that the EU is implementing this Action 12 across all the EU member states. And if you remember, we talked a little bit, I think, in the past about country by country report. Those are also transparency initiatives where it's implemented also through the DAC, and that was DAC 3. So in a way, it's really a series. It's the latest of a series of changes that EU have made to make tax more transparent, if you like, across the EU member states. And DAC6 is an interesting development, because what it does is it tries to set the baseline for how member countries need to deal with disclosure standards. It's the minimum standard. So in a way, countries can go much more than the rules specify, but they will never be able to sort of put in a less stringent set of rules. And you will see later, hopefully throughout this presentation, that in fact, this baseline is actually very, very stringent. And surprisingly, there are 1 or 2 countries still that goes a little bit further than this baseline, right? What does the EU directive try to do here in terms of DAC6? It has really 2 objectives. Essentially, one is to ensure that the tax authorities receive information about tax planning arrangements. The other aspect is that once they have received this information, it facilitates the exchange of information among member states. So essentially, there are actually 2 elements to this directive. One is to force either the intermediary or the taxpayer to provide that information to the tax authorities. And the other is to make sure that the tax authorities are able to share this information with other countries that have interest in the tax arrangements. So even though it says it's really around disclosure, it's actually also an automatic exchange of information mechanism in there. The directive has non-compliance penalties. So essentially, if you have to comply and you fail to do so, then there are penalties. Again, here, the directive doesn't really specify the actual amount of penalties. It's left it open to countries. But it does say that member countries have to impose penalties that are effective, proportionate, and dissuasive. And so far, what we have seen is quite a big range in terms of how you interpret effective, proportionate, and dissuasive. It can range from 2,000 euros to 860,000 to 2 million. So it's pretty big range in terms of the penalty involved. The other aspect is the taxes covered. Essentially, it's a very broad directive in the sense of all taxes that are covered, except VAT, excise, customs, and social security contribution. So if you enter into an arrangement to plan around employee taxes, for example, that's actually covered. But if you are planning around social security contributions, then that's not actually covered because it's specifically excluded. There are some subtleties around these rules as well, but it's fundamentally quite a broad directive, essentially. To the next slide, I think the idea of this directive coming into force creates a lot of stress, actually, in the EU, and as well as sort of all the taxpayers outside of the EU. One of the reasons it's created a lot of stress is that the directive came into force actually 2 years ago, 25th of June, 2018. Essentially, the member countries have until the end of last year to implement these rules in the directive. By and large, most countries have done so. I think there are 2 or 3 countries that haven't actually got their legislation in place yet, but they will soon sort of catch up. After the legislation is in place, the effective date is supposed to come in from 1st of July 2020. So in a couple of weeks, everything will become effective. And then the original deadline says that the first filing requirement is from 31st of August, with this information to be exchanged by 31st of October 2020. So essentially, the reporting deadline for 31st of August covers actually the arrangements that you entered into back to 25th of June 2018. So there is a retrospective element in this proposal. So once the law comes into effect, it will catch all the transactions that you've entered into since 25th of June 2018. So you have to go back, do a catch-up inventory taking, make sure that the reporting obligations are met for all the arrangements that you've entered into 2 years ago. Yeah. And that actually, I think, is one of the big stresses in the system at the moment, because in 2 weeks' time, you have to really sort through all your transactions back to 2018 and then come to a position about whether you report or not to report. Because of COVID-19, there is a discussion at the moment that this filing deadline might be deferred by 6 months. Some countries actually have announced that they are going to defer. Instead of 31st of August, it will be 28th of February 2021. It gives you a little bit more time to organize yourself. Unfortunately, it doesn't affect the effective date. So still the obligation to report will crystallize on 1st of July 2020, just because you don't have to put in the filing 28th of February 2021. That gives you a little bit more time to sort out what kind of information you need to put into the system. But the obligation is there in another 2 weeks, essentially. Yeah. I think that's really all about timing. In terms of what needs to be sort of reported, there are sort of different concepts embedded in the directive, and the general rule says that a cross-border reportable arrangement is an arrangement that meets these characteristics, yeah, on the slides. Essentially, it has to involve taxes of every kind except VAT, customs, excise, and social security contributions. As I said, if an arrangement is to plan around VAT, it's out of scope. You never have to report that arrangement under DAC6. Yeah. If you plan something around customs, social security contributions, or excise, they are not reportable. It takes you out of the scope. The other important thing is that for the implementation date, it's 25th of June 2018. So anything that you've implemented after that date, it's in scope. All your existing arrangements up to that point, things that you have done before 25th of June 2018 is out of scope. So you don't have to go back further than 25th of June 2018. But to be honest, 2 years is quite long enough. But still, 2018, 25th of June is the cutoff point. Anything before that, you don't have to worry. The other important thing that to bear in mind, it only covers cross-border arrangement. And if you are involved in a transaction that's purely domestic, it doesn't have to be reported. It is something that that involves cross-border. And I think in this context, because we're talking with now with Brazilian companies and taxpayers, it's also important to bear in mind that unless one side of your transaction touches on the EU or the UK, this DAC6 reporting obligation also doesn't apply, because it has to be an arrangement that concerns more than one EU member state or one EU member state and a third country. Yeah. But if you do have transactions, let's say between Brazil and the holding companies outside of Brazil, then those kind of transactions, they will be covered by this cross-border reportable arrangement definition, because one side of it touches on one of the EU member states. The other group of transactions that needs to be reported are things that are designed to avoid automatic exchange of information, or structures that are designed to hide the identification of beneficial ownership. So those are actually specific categories of reportable transactions in DAC6. And if you are in that space, then it's a separate category altogether that will trigger reporting obligation. Yeah. I think this is sort of some of the big picture sort of triggers. And in practice, these are quite helpful in a way to get you out of scope, right? So if you have transactions that don't involve covered taxes, then they're out of scope. Helps with filtering out transactions that you have done since 2018, essentially, to make sure that these are not. And then what's left inside, then what you have to do is to go and assess essentially each of the hallmarks that the DAC6 has set out. So in order to be reportable, or the reporting obligation actually applies only if you meet this definition of a cross-border arrangement, involves one of the EU member state after the implementation date, it's cross-border, and it involves one of the covered taxes, then you have to go and assess the hallmark. That's on the next slide. So essentially the hallmark are sort of specific rules where if you have an arrangement that meets this characteristic, then it will trigger reporting obligation. There are 5 categories altogether, so A, B, C, D, and E. Across this, there are 19, depending on how you look at it, 19 or 20 subcategories in there. And each of these categories have to be assessed essentially in terms of the context of your cross-border arrangements when you try to decide whether they are reportable or not. Category A is the generic hallmark. So it has things like confidentiality, contingent fee, marketable arrangements. So if you have arrangements that have this kind of feature, then it will require you to consider reporting if the arrangement meets the main benefit test. And the main benefit test is satisfied if it can be established that the main benefit or one of the main benefits is to obtain a tax advantage. So it's sort of in traditional legal language for an anti-avoidance rule, very, very vague. So if you do have one of these hallmarks, then a lot of stress is going to be created because you're thinking, oh, did I meet this main benefit test or did I not meet this main benefit test? And if you do meet the main benefit test, then you have to report. So a lot of the time, the main benefit test provides you an escape. So if you have a lot of other commercial reasons why you're doing these arrangements in such a way, then you might get carved out from reporting. Otherwise, you fall into the reporting obligation, essentially. There are 3 other categories, which are specific categories. So these are utilization of losses, conversion of income into capital or low tax income, circular transactions that will trigger reporting. Category C's are cross-border benefits, where you might have a deduction on one side and the tax pickup on the other side is very favorable, either because the entity receiving the income is in a zero tax or no tax jurisdiction or low tax jurisdiction. Either the income is fully exempt or there are preferential regime on the other side, or if in those cases, you have to actually assess whether you meet the main benefit test or not when you decide whether to report. There are a bunch of other categories that don't have the main benefit test. So if you fall into these categories, you have to report. And essentially those category C items, again, they are looking at cross-border benefit, right? So if you have deduction on one side, and on the income side, it is falling into one of the non-cooperative jurisdiction, for example, Cayman, then it will trigger reporting obligation. If the recipient has no tax residence, so it's like one of those stateless entities, then it will also trigger reporting. Yeah. The other 3 categories that will trigger reporting are sort of double dip structure. So if you have a structure where an asset is depreciated twice in 2 different countries, that will trigger reporting. If you pay one lot of withholding tax, but the withholding tax relief is claimed in 2 different countries, that will also trigger reporting. And I think the last one actually is quite an important one, is where you sell an asset and this income or the remuneration on the transfer of this asset has a large discrepancy, has a discrepancy between the transferor and the transferee. And this might happen, for example, if you sell something based on the safe harbor and on the other side, they value it in a different way based on market price. And there you might actually create then a discrepancy in the consideration of the transfer of asset. So that can trigger also a reporting obligation. Category D there are 2 subgroups. Essentially, they are sort of arrangements that are designed to avoid common reporting standards or to actually to hide legal or beneficial ownership chain. So these are very specific structures. So if you're doing that, then just be aware that in the EU, that you have to report. And then finally, this is the surprising part, is there are a bunch of transfer pricing hallmarks, 3 of those. When you do transfer pricing and you use a unilateral safe harbor, which I think in Brazil is relatively common, that will trigger reporting obligation under DAC6. The other situations are a little bit less usual, but still very common. So when you do restructuring and you transfer hard to value intangibles, or the transferor and transferees, you've done intra-group conversion arrangement and the transferor's EBIT is significantly impacted, then it will also trigger reporting obligation. So essentially, this sort of 20 categories of hallmarks that will trigger reporting for cross-border arrangement. I think one of the things that have been really creating a lot of stress in the markets and in conversations with our clients is that actually these 5 categories of hallmarks can bring into play a lot of transactions that people see in the tax department. And some of those examples I've tried to kind of summarize here. So for example, if you look at this, then one thing that I would say is there are sort of routine transactions as well as ad hoc transactions. And the interesting thing about routine transaction is that these are the transactions that happen in multinationals on a day-to-day basis. So often you don't have any intermediary involved. You are doing it yourself in the in-house tax team. And if they trigger a reporting obligation on a routine basis, then actually it will be your responsibility as the taxpayer to report, because there will be no intermediary involved, right? And if you fail to report, then the penalties will be on you, right? Because you are the taxpayer and no one else is involved. The ad hoc ones is a sort of one-off restructuring or acquisition transactions. They might also trigger reporting obligation. And there, typically, you know, a multinational will have advisor. So if you look at the reporting obligation, typically that will fall on the advisor and not taxpayer. So there are different way to think about your compliance obligation, depending on whether it's a routine transaction or it's an ad hoc transaction. In terms of different categories of transactions that might be reportable, we think it's actually very broad. For example, all the treasury operations, you have financing structure, then there are two categories that are important. One is circular transaction. So if you have put money into a financing company and the financing company lends back the money into your entity, then that will be a circular flow of funds, and that will trigger actually reporting obligation potentially. The other category that this could trigger is financing usually have interest. If you have interest deduction on one side and income pickup on the other side, then category C is also relevant to think about. Supply chain transactions, so even if you buy, sell goods, it can trigger reporting obligation. In particular, I think in the Brazilian context, for example, if you apply safe harbor in Brazil for the sales margin, and on the other side, you don't use the same safe harbor, maybe you use OECD standards, that can create discrepancy in the amounts payable. And that will be a category that trigger reporting. Again, the use of safe harbor will trigger reporting. So there also you have issues around how you look at it. Services and royalties. So essentially, if you have intra-group arrangements, then category C is something that you have to look at, because deductible payment on one side, income pickup on the other side. If there's a cross-border tax benefit involved in there, then it might trigger actually reporting obligation. And finally, the routine transaction that actually surprises everybody is really your employee benefit types of arrangement. That potentially also can trigger reporting, because you might think about substituting your remuneration that is typically taxed in the hands of the employees with sort of stock option plan that might not be taxed. Yeah. And if you do this in a cross-border context, then actually category B2 is relevant. And you have to think about, well, does it meet the main benefit test, right, in that sort of arrangement? And if you don't really justify why you're doing it and think about the commercial context around why you have this kind of arrangement in place, it creates a reporting obligation that you need to actually really address. The other interesting thing about this is that actually as a taxpayer, if you're offering this to your employees, then actually you are the intermediary, because you are designing these things and making it available for the employees to do these things. So you have to really look at this not from your point of view as a taxpayer, but actually as an intermediary. And then finally, I think the ad hoc transactions, these are pretty sort of expected, if you like. If you're doing any restructuring, if you're doing any mergers and acquisition, then actually looking at DAC6 is going forward going to be part of the consideration of the tax advice that you're going to get whenever you do transactions involving one of the EU member states or the UK. I think that's kind of for that. I'm just conscious of time a little bit, so maybe we move a little bit faster. once you sorted out what is reportable, then the next question is who is going to do the reporting. And for that, I think there are two parties. The primary responsibility is on the intermediary. It's very broadly defined, except that intermediary has to be EU connected. Yeah. So if you are not EU connected, intermediary doesn't have to report. Default obligation is on the taxpayer. And so if you don't have any intermediary doing the reporting, then it's the taxpayer that has to do the reporting. And the important thing to note here is that for the taxpayer's obligation, is no connection to EU needed. So for a Brazilian taxpayer, you can have obligation to report if you do cross-border reportable transaction that touches on the EU. So if you don't use any intermediary, that makes it even worse because you are obliged and penalty will be on you to report as the taxpayer. Okay. The next slide, I think, goes through a little bit flow chart around when is taxpayer responsible and when is the intermediary responsible. So if you do something and there's an EU intermediary involved, then you have to ask if the EU intermediary able to claim legal professional privilege. So if you use lawyers, then they are able to. And if they are able to claim legal professional privilege, then is there another EU intermediary involved? And if that is yes, then is the EU, then it's the intermediary that has to report. The taxpayer has no obligation in this case. But if at any point the answer to this intermediary is no, then the default position will be that the taxpayer will be reporting. And it's very important to sort this out because if the intermediary is reporting, then you obviously don't have to report, but you might still be interested in the information that this intermediary is filing on your behalf, right? If you have to report as the taxpayer, then it's very important to get on top of this because the penalties will be on you if you fail to report. Right? So this is, I think, one of the big questions that companies have to go through to figure out. And finally, I think this is an overview. I won't go through this. I think this is something that we've helped clients to work through is essentially, I think the first 3 sets of questions are trying to figure out, is there something to report? I think everybody has to do that. If the answer is no, then you put it in a bucket and say, we have these arrangements, we've looked at it, nothing is reportable. If something is reportable, then you have to figure out who has to do the reporting. So the question to ask there is there a person who helps you design this thing? Is there an advisor involved? If there is an advisor involved, then is there an EU advisor? If there's no EU advisor, then the reporting obligation falls back onto the taxpayer. If there's an EU advisor, then the next question is the EU advisor covered by a legal professional privilege? If it is not, then it's the intermediary that has to report. Yeah. So if you go through this compliance chart, essentially what you end up with is really a bucket of transaction where you don't have to report. You might need to keep some documentation around why you think it's not reportable. A bucket of transaction where you say, okay, it's reportable, but I am doing the reporting because there's no intermediary involved, right? And then there's another bucket which says this is reportable and one of my intermediaries is doing it. So there, the thing I have to do is to control what is being reported on my behalf, right? And so I think this flow chart kind of gives you a guideline around, okay, if I were to try to comply in DAC6, this is how I would do it. Alex?
Thank you, Shibon. That was excellent. A lot of good information here and things that Brazilian multinational companies or even Brazilian companies doing business with EU state members should be aware of. We'll try to come back for questions at the end, Shibon. But in the meantime, I want Victor to comment, you know, putting a Brazilian eye on what we just discussed. What is your reaction and commentaries, Victor? Victor, you're muted. You have to unmute, please.
Thank you, Alex. So my first reaction was, hey, this is not all new for us. Because back in 2015, the Brazilian government tried to pass a provisional measure which was trying to implement mandatory disclosure of tax planning in Brazil. And just like DAC6, it was very broad and would hurt taxpayers a lot, because under the scope of Section 7 of Provisional Measure 685, you would have to report any type of transaction which was carried out solely for the purpose of avoiding tax. And the law, the provisional measure, didn't bring any other concept or any other hallmarks, you could say, that could define which type of transactions would be reportable. And the worst thing of this thankfully failed provisional measure was that if you failed to comply with Section 7, then you would be assumed to have committed tax fraud. So I think that the government went a little bit too far, and that scared a little bit of congressmen. So it was not converted into law when provisional measure was voted back in 15-16. But having said that, I think that from DAC6 purely perspective, what intrigues me the most is what EU is going to do with the information. Would this information that EU gathers under DAC6 rules would be shared with Brazilian authorities, for instance? Because as Shibun said, there are a lot of cross-border transactions between Brazilian companies, whether it's inbound or outbound, that could fall within the scope of the hallmarks and be reportable under EU law. And so would that information be exchanged with Brazil under, let's say, the 16 tax treaties that Brazil has with EU nations? Granted, these are older treaties. Most of them have exchange of information, very basic rudimentary provision. But would that information actually get to Brazil? So this is one thing that Brazilian companies, in addition to complying with the scope of DAC6, they need to keep in mind that this information may, in the future, come back to Brazil in the ways of the exchange of information treaties. And so as Shibun mentioned, and I just want to wrap this up, there are a few transactions that could impact Brazilian companies. And the most important, Shibun already mentioned, was the transfer pricing mismatch between Brazilian fixed margins rules and the OECD arm's length principle. So to the extent that we have Brazilian companies applying a fixed margin rule on the export of goods, and they only have to pick up so much income, and you have a EU country which applies arm's length, and they are able to acquire these assets on a higher cost, then you have no income floating around between, no taxes on that mismatch between export prices and EU arm's length acquisition costs. So something that Brazilian companies need to keep in mind. Also, I can mention the royalties, and Brazil had very stringent, very limited deductibilities and royalties rules, which are different from the OECD standard. And we have also even the safe harbors for export of goods. There are a lot of cross-border transactions that, if we think it through, it could fall within the DAC6 rules. So even though in the first moment when you read the rules, you may think that this is not really important for Brazilian companies, but to the extent that Brazilian entities, they have any EU connection, whether you have a parent company, whether you have a commercial transaction in Europe, whether you have subsidiaries, branches, whether you have a trading company, a holding entity, or IP holding company, then you should definitely be aware of DAC6 and dig into the transactions and the cross-border transactions that you have with Europe. So I think, Alex, these were my first impressions on how they translate into for a Brazilian company.
Thank you, Victor. That was very helpful. And, you know, mindful of time, I just want to turn to my good friend, Randall Fox, who we're going to change gears a little bit here. Victor mentioned about Brazil and the OECD, and Brazil wants to join the OECD. So, Randall, can you please tell us, you know, what Brazilian companies should be mindful when you talk about OECD and the transfer pricing guidelines, please? The floor is yours, Randall.
Yeah, sure. Thanks, Alex. Can you hear me okay? All right, since I'm actually using my phone. Okay, great. So yeah, I think it's going to be a lot to think about for both Brazilian-based companies and just companies operating in Brazil with this shift towards the arm's length principle, which comes with this OECD accession package. I worked a lot with Colombia on their accession when I was with the World Bank Group to really get them up to speed on implementation of the arm's length principle in Colombia. And it was quite a process. And I think in Brazil, it's going to be even more of a process starting at a completely different standard with fixed margins. So it's going to be interesting to see how it plays out. But let's talk a little bit about stepping back on what the arm's length principle is within the OECD guidelines and what that's really going to mean with respect to Brazil. So let me just see what slide we're on. We can go to the next slide. Yeah, so the OECD guidelines. So Brazil is really the last bastion of fixed margins left in the world. Pretty much every other country has moved to the arm's length principle at this point. So 100+ countries follow the OECD guidelines, which is really the standard, international standard for pricing of transactions across border, but within a multinational group. And that standard really is such that those transactions should be consistent with how independent parties would operate and price those transactions. That is the arm's length principle. And so what does that apply to? So we have some examples on the slide off to the right here. So where intangible property is actually sold from one party to another, that needs to be sold at a price, as if it were consistent with what independent parties would sell intellectual property for. Licensing transactions, the same. So the royalty rate associated with those and the terms and conditions associated with those licensing payments. Again, sticking with the intangibles theme, cost-sharing payments between parties, including entering a cost-sharing arrangement. Services, I think, is going to be a big one, particularly where there are services that are not currently identified. This is going to be more and more important. We'll talk about that in a minute. Financing, so any sort of intergroup loans, cash pooling, so financing arrangements in and out of Brazil will need to be priced as if they are between independent parties, consistent with the arm's length principle. So what does all this mean? Is this going to create some tension? Victor talked a little bit about some of the mismatches between a country with the arm's length principle and Brazil's fixed margin. So that if the arm's length principle is implemented in Brazil, that will of course be harmonized a bit. Now, fixed margins are relatively certain in a sense. You know kind of what you need to apply given a particular fact pattern. Moving to the arm's length principle takes into account new factors, so comparability, particularly functions, assets, and risks of the party, really determine what, if we're just sticking with the margins, what sort of margins that Brazil company or company outside of Brazil should be earning. So instead of just having a fixed number, now it's completely based on comparability and what is actually happening in those countries. So functions, assets, and risks, super important. Economic circumstances, business strategies, contractual terms, characteristics of the products or services, all these things are going to become important. So it's a much more involved analysis than determining whether you apply the fixed margin or not. Now, that's going to be harder to implement. And in some cases, you might result in more tax being paid in Brazil. In some cases, it might result in less tax being paid in Brazil. So it's harder to achieve certainty as well. So there'll be more risk around certain transactions. It's very uncertain how Brazil will implement this. But also there could be opportunities in structuring transactions in a way to sort of optimize, given that the arm's length principle will be introduced. So we can go to the next slide. We'll talk about some questions you can be asking right now, or that may even be asked of you if you're in-house. So are transactions mapped properly in and out of Brazil? So this is something you might have looked at in the past, regardless of whether they're on the arm's length principle or not. But now, of course, it becomes much more important, since you actually have to demonstrate, or will have to demonstrate, that the pricing of these transactions are consistent with the arm's length principle. So step one is really identifying those. So the one I think we're seeing quite often is services that might be provided in Brazil outbound for other companies, just making sure all of those are captured. So and actually both directions. So is the Brazil company or foreign companies benefiting from services that are happening in Brazil? Or is the Brazil company benefiting from services that are happening outside of Brazil, but within the group? So capturing those transactions and making sure they're priced consistent with the arm's length principle is key. So I think one of the, thinking about this from a CFO standpoint or a head of tax, one of the key questions they're going to ask is, okay, the arm's length principle is coming, great. So what does this actually mean? So what is the actual tax impact on Brazil? Am I going to be paying more tax in Brazil, less tax in Brazil? So I think just looking at the fixed margins, and how the rest of the world operates, with respect to distribution, there's a good chance, if it's very routine distribution in Brazil for products being sold, there's probably going to be a lower margin than the fixed margin when you implement the arm's length principle, which might mean less tax being paid in Brazil. For outbound sales, let's say of goods, it really comes down to intangibles, I think. And this is where it's really going to, you really have to think about how the intangibles are being used in Brazil, or where they're owned in Brazil or outside of Brazil, if those are embedded into the product or not. So for products being sold from Brazil to the outside, are there intangibles embedded in that product price? Are those intangibles owned and managed in Brazil or outside of Brazil? If they are outside of Brazil, then maybe it's more of a sort of routine manufacturing or production operation. But if they're in Brazil, then maybe you need to think about whether the distribution on the other side is more routine. So a lot of what it's going to come down to is requiring to be much closer to the business than you might have been in the past. So understanding really what those intangibles in the business are, how they're being used and managed, is a big piece of the puzzle in determining your pricing here. So, and once your transactions are sort of identified and you have an idea of what the impact is going to be, just making sure you cross your T's and dot your I's. Do you have your legal agreements in place? This is going to become more important as the arm's length principle comes in, because if you look at the way courts have interpreted this around the world, the legal agreement is always the first starting point. And so I would guess the same will happen in Brazil. If the legal agreement clearly states between two parties that the pricing is such, and it's, the terms and conditions are consistent with independent parties, then it's just really about defending the pricing of that. Other courts have tried to, or other governments have tried to recharacterize or recast transactions into something else. But where there's been a good legal agreement in place, that's been more difficult. So And the last piece beyond the financial impact is just looking at operational impact. So, you know, you may get asked at some point by the board or by the CFO or by the head of tax saying, you know, we want to understand what the implications here, but there's an operational element too. So there's going to be compliance associated with the arm's length principle in the form of documentation. The OECD has a standard documentation package that they expect each country to have to really demonstrate that they're meeting the arm's length principle. So I would expect Brazil will roll out something similar when this happens. So the new compliance element, there's also how do you actually administer your systems to make sure that you're in compliance as well. So I think that there'll be new risks, there'll be new opportunities, there'll be new compliance obligations, and there'll be a tax impact one way or the other within Brazil. So that's sort of how I see this rolling out. Just going to the next slides here. So around understanding your risks. This slide is really intended to, you know, for other countries. So we have a sort of risk scale on the right for how aggressive we think certain countries are with respect to the arm's length principle. And this has an example of a sort of financial transaction where you have a lender and a borrower. And what are the possible risks and exposures here? And with respect to Brazil, again, it comes down to what I was saying earlier. How is Brazil going to interpret and enforce the arm's length principle on transactions like this? Will they have the training to be able to do this comprehensively? Will they have the database access to really find comparable data to transactions like this, to be able to assess it in a way that is consistent with the arm's length principle? So I know that Brazil has been getting training from the OECD and other organizations for a few years now in preparation for this, and I think that's ongoing, and they're steaming ahead with it. So it's but you know, when the time comes to actually for them to be looking at these sort of things, it's quite an unknown how they'll approach them. So just steaming along to the next slide here as we're running out of a bit of time. So I already talked to you a little bit about, you know, how you might approach this, but this sort of lays out a process. So, and what we mean by the first step of functional analysis is really, again, getting closer to the business. This really involves, and this is a fundamental step in transfer pricing analysis, is really having a discussion with the business and trying to understand the value chain. So who's really driving value in the organization? Is it in your case, is it in Brazil or is it outside of Brazil? What are the activities? Who's managing the key risks, and what are the key assets in the process? And then mapping your transactions, estimating what your arm's length pricing would be based on those transactions. And this is something we do, just, you know, giving a high level estimate of sort of where we are and what sort of impact this might have over the next few years. And then assessing whether the tax department has the operational capacity and what's the impact really in that respect. So, okay, I think we can go to the next slide, which is more on legal agreements. Again, just making sure you have your T's crossed and your I's dotted here. Just have legal agreements where you've identified transactions with arm's length pricing. Let's skip the next slide and go down to pillar 1. I think this is something I want to cover before we wrap up here. So just as Brazil is, make sure we're on the right slide here. Yeah, one more, keep going. Yeah, next one. So just as Brazil is steaming towards the adoption of the arm's length principle, it's somewhat ironic, but the OECD is stacking things on top of the arm's length principle and actually moving arguably towards more what Brazil's system is, believe it or not. So despite everything I just said. So it's primarily aimed at digital companies, but also in other areas of distribution and consumer goods. So the political backdrop here is countries are rolling out digital services taxes to try and, attack technology companies that they believe were we're tax avoiding. Now with a boom in e-commerce and digital advertising spend, public is calling for technology to be taxed in new ways. So countries were rolling out individual country digital taxes. And now the OECD has gotten on board to try to get their arms around this situation. And so they're taking this sort of two-pillar approach to this. And pillar one stacks on top of the arm's length principle with new elements of taxation for local countries where there are significant users or goods being sold into through e-commerce. And the next slide sort of breaks down the three elements of what that is. So amount B in the middle is really one more consistent with the current arm's length principle, which may, the OECD may come out with something that actually fixes this, similar to what Brazil has for particular industries. Now, there's two other elements to this. Amount C could be anything else additional, so market-specific characteristics or marketing intangibles that go beyond what a routine margin would be. And then amount A is actually allocating, the company's residual profit out into the source countries in a almost more formulaic way. This is still to be determined, a lot of the details around this, and so I'll turn it over to Shaboon on the next slide to talk through some of the open points here around this.
Yeah, I think just to jump in quickly because of time, I think really everything is open for discussion, including some thresholds in terms of what kind of business will be in scope to have to allocate amount A, how you calculate the tax base that is subject to allocation. So essentially the idea at the moment is to start with financial statements and say actually come up with a profit before tax for the in-scope business and then figure out, okay, out of these profits, how much of that is residual profits that can be allocated to market, and then arriving at a formula to allocate it to market. And we're not talking about all markets, we're talking about really markets where there are substantial nexus connected with this business, right? So OECD is also looking at, okay, if you have in-country revenue of X amount, then you will have enough nexus to be able to get these residual profits. But if you are not really a significant country with not enough nexus, then you might not be allocated these residual profits. And in any case, there are also going to be formulas coming in to look at how you determine the amount A. I think amount B is very similar, as Randall said, to what actually countries like Brazil has. It's a safe harbor. It's going to be discussion around whether it's going to be sectoral based or sort of standard global safe harbor. Randall?
Yeah, I think that's right. In the interest of time, should we just jump straight to Q&A, Alex or Victor?
Yeah, I think Victor will give a quick update on the discussions between the Brazilian authorities and the OECD, just where we are. Victor.
Yeah. Thank you, Randall. Thank you, Alex, Shaboon. So since 2018, the Brazilian tax authorities have been meeting with the OECD folks to discuss the alignment between the Brazilian TP rules to the arm's length principle. And a lot has been done since 18, and the state of things now is that Brazil has decided for the full alignment approach, where Brazilian transfer pricing rules would migrate to the arm's length principle. That alignment would be gradual, and in a pre-COVID timeline, the tax authorities would take 2020 to draft the new statute. So in 2021, they could discuss with members of society and maybe reach to a final draft, which they could introduce and propose for voting before Congress. Now with COVID, I think that the timeline is a little bit more blurry, but hopefully this will get done by even the end of the year or maybe the first semester of 2021.
Thank you, Victor. We are getting to our time. I want to thank you all participants, and any questions that we have here, we will address directly, and I will pass to Humberto to make our final remarks.
Yeah, I would like to thank everybody, mainly the speakers. And I think that we ran out of time, but there were many important issues that were addressed here. I think I will just point out a couple of things. It's an important issue that was addressed by Victor refers to how and when this information may flow or be exchanged by with the tax authorities, Brazilian tax authorities, because we live here, as all the taxpayers in Brazil know, as a witch hunt, and whatever the taxpayers do, it is challenged by the tax authorities. So it is a big concern. And another thing is regarding the penalties. I know that there are many, as Shibu mentioned, each state can rule their penalties, and that's the importance of knowing if we are, I mean, if the companies have to prepare the DAC6 or not. That was the main focus of the Shibun presentation. And again, if anyone has some question, we will address you later, because we ran out of time. I'd like to thank you again, everybody, and we hope in the near future we can go back to you with another webinar or another tax issues for everybody. Thank you. Have a great day.